we'll start with tariffs. And we're going to talk a little bit about what a tariff is, right? And some of the functions that it ultimately serves. So at the end of the day, a tariff is essentially a tax on a good that is imported from another country. They're used to help protect domestic producers, right? So if we're bringing in a product from another country and we put a tariff on top of it, then that makes that product a little bit more expensive. And in doing so, it in theory helps to protect a domestic producer of a similar product, because the domestic producer then would not be subject to that tariff. So tariffs can ultimately serve any one of four sort of different motivations or fundamentals behind what a tariff is set out to accomplish. First is the notion of decoupling, which basically means that it helps to shift supply chains and ultimately reduce reliance on certain countries. So you hear a lot of that kind of, we want to be less reliant on other countries. So that's certainly part of the current conversation about tariffs, is that decoupling notion. Rebalancing is another sort of different purpose, if you will, of tariffs. That helps to reduce trade deficits and boost domestic production. If you haven't checked our trade deficit lately, it's a really big number, like over $1 trillion. So, okay, so that might be something worth talking about, or at least focusing on. Negotiating is another purpose of tariffs, and that obviously helps to use economic pressure, right, to help to achieve certain policy outcomes. And then lastly is the funding aspect of tariffs, where you can use that money to help generate revenue to fund budget priorities. Interestingly, before World War I, that was kind of what this country was based on in terms of where it got its funding from. It was all tariffs prior to that period of time, and then it flipped to an income tax system. Now, two sides of every equation, right? And I assure you the tariff is a kaleidoscope of issues that are extremely complicated in terms of how it all interacts. We've got one side that is talking about tariffs starting a new trade war that ultimately nobody wins, because it's just, well, I'm going to put 10%, or you're going to put 10%, I'm going to put 15, you're putting 50, I'm putting 20. You see how that can kind of rapidly escalate. And then at the end of the day, it certainly has an inflationary pressure, right? Because if costs are going up, then things cost more. That's called inflation. On the flip side, of course, is you have the folks that are saying, well, these tariffs, it's an attempt by the U.S. to reduce some of these long-term trade deficits and compel other countries to lower their own protectionist measures. So in either case, it certainly does reflect a shift in sort of the geopolitical world order that probably is just beginning. Tariffs at the end of the day certainly can reshape supply chains. They can alter competitive dynamics for different businesses and sectors, and certainly influence international trade patterns. So that's kind of the background on kind of the tariffs. Let's take a look at some of these numbers and sort of talk through the current climate. And I think this is the part that is kind of interesting to help bring some perspective into the current headlines. So current trade deficit, $1.1 trillion. That's real money when you stop and think about that. We buy way too much junk, and put it nicely, and sort of need to figure out a way to level the playing field, if you will. U.S. has been running a trade deficit every year since basically the 1970s. And then the other issue that is real is there is a competition issue here. Lots of countries are and have been imposing tariffs on U.S. goods coming into their countries for some time. Just easy example is on a car. And, car, that's a pretty big ticket item, right? I mean, it's one of the bigger ticket items that you'll purchase during the course of any given year. And when you think about Europe's tariffs on our cars, so think like the Ford coming into Europe. Okay. Tariff there is typically like 10%. Now, a European car coming into the U.S., the tariff is 2.5% as it stands now. So the tariff that our car is getting charged to sell in Europe is actually 4 times greater than what we're charging for their cars to come into our country. So doesn't that seem a little unfair? So, look, we understand the messenger at the heart of this is not some cuddly-wuddly bear that can, explain the nuances in a kind and gentle way. I wonder if this, if this was Clinton or Bush or something like that, that maybe the messaging might not be, as I guess, difficult. It might be a little bit more nuanced, right? But this is not necessarily revolutionary thinking of what we're seeing here. These are not, made up issues. These are real issues. When you start to think about tariffs and the impact of tariffs and what that is on our goods going into other countries, and kind of how all of that plays out, I certainly think it would be nice if the message was maybe a little bit more nuanced or maybe a little bit more explained, I guess, might be the issue. But the reality is that, those are the numbers. That's how all of this kind of plays out. Let's not forget about VAT taxes as well, by the way. A lot of countries put those on production along the way. And if you kind of think of that from a European perspective, that might be a little bit more. When we think about the trade deficit, 1.1 trillion, that is a real number. And we think about tariffs and what tariffs are imposed on U.S. products abroad, that's a real number. When you think about cars going to Europe from here that face a 10% tariff, whereby cars going from Europe to here face a tariff of 2.5% currently. So there is something to talk about here, and maybe the messaging could stand to be a little bit more nuanced, and we can certainly all debate that, but we're not here to debate politics. We're really trying to talk through what the implications are of these tariffs, because tariffs serve a variety of purposes and have always served a variety of purposes throughout history. Remember, before World War I, we didn't have an income tax system, we had a tariff system. So just a little perspective, I think, goes a long ways. And if you look at some of the VAT tax stuff, the value-added tax stuff that many countries apply on production along the way, in the case of the EU, if you take the VAT tax into account, actually sort of implies a much larger tariff of about 25%. So a little perspective, I guess, on it. Certainly in the short term, tariffs can be inflationary. There's no question about that. There's not really a whole lot of debate there. But how it actually plays out over time, and I guess that's the point, and one of the things that we're going to be talking about on the program is that how it plays out over time, I think, is a little bit more complex. More often than not, that cost is divided between consumers and businesses. Consumers, obviously, in the form of higher prices, but businesses in the form of sort of lower profit margins. So I think at the end of the day, the tariff conversation is certainly not a easy to follow or easy to understand issue. The important thing to remember, though, is that you do have to have some conversations about this one. It's way too big of a trade deficit. There are protectionist measures that many countries are imposing on U.S. companies that are simply not creating a level playing field for our U.S. companies to compete abroad. So a longer-term issue, if you will, that is certainly, changing some things up. Some things good, some things bad. And right now, of course, the markets are trying to figure out all of that, right? That has led to certainly a much greater increase in volatility, but volatility passes. The important thing to always remember in periods of time like this, so the bottom line here really is, your investment should always be focusing on sustainable companies, businesses that have sustainable competitive advantages, if you will, and diversifying across different geographies and sectors that ultimately are going to have varying tariff sensitivity. The impact of tariffs can certainly dramatically differ between different sectors of the economy, with some industries facing more challenges and while others seeing more of an opportunity as it relates to this. Even on a company level, the impact can vary. So, you might have more a company with more flexible supply chain, or perhaps a product that isn't going to be as subject to tariffs, like maybe cloud computing. Those are where some opportunities are. And along that same lines, you would also see certain competitive advantages for domestic focused companies, right? So if I'm a company that generates most of my revenue here in the U.S., then the tariff thing isn't really that big of an issue per se. So that's would be businesses in banking or utilities or financial services or even healthcare sort of come to mind. Beyond that, international side of things is another option that it certainly is showing some opportunity, particularly for those countries that maybe aren't directly involved in being the target of some of this trade and tariff stuff. We see that in places like Vietnam and Thailand have obviously benefited greatly from various supply chains moving out of China. So market's clearly trying to figure out all this, right? A lot of volatility, from a historical perspective. Week before this past one, you saw a market correction, which for those of you who aren't familiar with what that term is, the technical definition of is a market correction is a 10% decline from a prior peak that occurs in the market. So as of week before last, the S&P 500 had sort of checked the box, if you will, on that market correction and had declined 10% from its record peak on February the 19th and went through that decline of 10%. It actually happened within 16 trading days. And you may say, wow, that's really quick. That has to be some kind of a record because that was, 16 trading days. That's, a little over 3 weeks. That actually doesn't even put it in the top 10 of market corrections in terms of speed of market corrections over the course of the past 50 years. Came in at number 11 with that happening in 16 trading days. So for perspective, I've been doing this for 26 years and, I've seen 13 different corrections. Had to ask AI on that one because, I'd kind of forgotten some of them along the way, which is sort of in line with the historical average. When we think about the historical averages, you do see those periods of time where the market shifts. Usually, 10% market correction, as the definition is, occurs once every couple of years or so. So that would, I've been doing this for 26 years, and so to see 13, that's kind of hits the average, if you will. Bottom line, they are never fun to go through. But at the end of the day, they do pass. And those periods of decline are much shorter than those periods of expansion. So remember that when you're thinking about your investments.